everyone, and welcome to your Glassnode video report for week 10, 2024. Well, Bitcoin is approaching, but arguably attacking the all-time high. In fact, on a closing basis at $68,000 yesterday, Bitcoin has closed at the highest price that it ever has in the US dollar. For those of you like myself, for Australians, we've got $100,000 Bitcoin at this point in time. And in fact, the US dollar is one of the last major currencies to see an all-time high. Bitcoin hit an all-time high in the euro and the pound. It's already been at an all-time high in most other major fiat currencies. So really the US dollar is kind of the last bastion, but it's also the one that the most people are looking at. So I think it's probably surprised a lot of people how quickly Bitcoin has got here. Certainly in the lead up to the halving, generally speaking, all-time highs come some distance after the halving event, and yet here we are in early March, and the halving is not expected until early April. So just giving a bit of a spread that this is it's kind of a bit of a historic moment, and very rarely does an asset hit its all-time high 3, 4, 5 times, but Bitcoin continues to defy the odds. So with Bitcoin approaching this all-time high, it is actually quite important to focus on regime shift. Now, what do I mean by this? Well, there's obviously been a lot of excitement and talk about the ETFs, and rightly so. They're taking in an average. This is not including just, at the moment, what seems to be a typical day of almost $500 million or more in net inflows. But on an average day, it's taking in over $250 million, right? This is taking an average over the entire time these ETFs have been active, and that is on the net value. So really quite extraordinary inflows into these spot ETFs. But it's important to know that there's many other factors where, as we've studied with this channel over, the last couple of years, long-term holders are typically the most active around 3 points. They're active near the cycle bottom, where you get people who have essentially ridden their first cycle from the top to the low, and they finally capitulate. They're active at the cycle high when they're doing the maximum amount of distribution. They're actually a key player that actually essentially puts too much supply into the market and oversaturates demand. But the other time that long-term holders go through a phase shift is as we attack the all-time high. Now, for whatever reason, in whatever format, what we see are these patterns play out time and time again. It is really quite, even myself, I spend my time studying this data, and it amazes me how consistent we actually see this playing out every single cycle. As Bitcoin gets to the all-time high, long-term holders, in our case, are up about 238% on average. We'll come and talk about that later on. And they have started their distribution cycle. Now, some of this is GBTC, but some of it is also people taking profits. And we released a report some time back called Following the Smart Money. And what we did there is we really explored this phenomenon, and we're going to kind of touch on some of those elements today. So this one's going to have a long-term holder theme, and that is because we've hit this kind of inflection point, let's call it, in their behavior patterns, and we can really start to see this playing out in their on-chain data. So as always, please do give us a rate, a share, and a subscribe. It has helped this channel get to more people. And we really do appreciate it. If you do have any comments or questions, you can always drop them in the section below, and I'm happy to answer those as they come through. So without further ado, let's get stuck into the analysis. Okay, so here we are in our week on chain 10 dashboard, and as per, I will start with our price chart, and you can see that we have our highest close up here above $68,000. So really, it has been a pretty spectacular move since October. If you've been following this channel for a while, I focus a lot on October 2023. The market structure really changed on a great number of levels. This was about the time when all the ETFs and BlackRock started to get into the scene, and the probability started to increase, and there was more and more conversations between the SEC and the issuers. We saw a real regime shift from October onwards. Just a couple of quick examples and just notes on what that is. We saw the realized caps start to accelerate. That's capital inflows alongside profit taking. We saw stablecoin inflows start to increase. We saw the overall realized profit, coin day destruction, lots and lots of metrics that describe activity really started to pick up. Exchange inflows and outflows started to explode. And we have also seen an uptick in Bitcoin dominance. So all of these things are actually very typical of what we see during this phase of the cycle. Bitcoin usually leads up to the all-time high and then generally some distance through it before the market has enough conviction to kind of move further out on the risk curve. So this is all very, very similar to 2020. It's very similar to what it was like back in 2019 as well. Very, very common market mechanics that we're seeing at this point in time. Now, just to put things into a bit of perspective, I quite like this chart. This is one where we're looking at all of the previous cycles from the previous all-time high. So our white curve here is our current cycle. And then we have our 2021, or sorry, 2018 or 2017 top all the way through to 2021. We have our 2013 top in red all the way through to our 2017 top. And for the argument here, let's ignore this early curve, the 2011 and 2013 cycle, because it was just a different world back then. It's a bit too far away to really pay attention. But the takeaway from all of this is that we are attacking the all-time high at a very similar duration. In 2020, we were pretty much at the exact same level. This is a point where we were touching 20,000 and kind of tussling around with it before it started its full run. It took a little bit longer back here in 2016 and 17 on the red curve, but we are more or less very much in line. Now, there's a lot of folks who are looking at the all-time high and measuring it from November, and of course that makes sense from a price perspective. But what you'll see here is there's our November all-time high. And the reason why is that, at least from my perspective, if we're going to be measuring duration, right, because the actual price, yes, that's one thing, but the duration that it takes a bear market to run its course, that's a psychological game. So when do you measure the psychology of a bear market from? Well, and if you've been following this channel, you'll be very, very aware of this. You're probably sick of me saying it. But really, April 2021 is, in my opinion, when the real bear market started. That was the all-time high. Pretty much every on-chain metric that describes long-term holders selling and kind of it's getting pretty toppy in here was January and February. We saw GBTC go into a discount somewhere around March. And from that point in time, and certainly beyond that first May sell-off that took us down from, it was up in the 50, 60,000s down to 29. It was a pretty brutal sell-off. We never saw on-chain activity pick back up. We never saw MVRV pick back up. We saw lots and lots of profit taking on that second rally, and there was a lot of malfeasance going on with the FTXs of the world. So really, bear market sentiment had actually set in for Bitcoin following that May sell-off, and we just never really had the juice on that second high. So as a result, if bear market sentiment set in here, this duration, strangely enough, and again, Bitcoin just seems to have this natural cycle, and I think it's all driven by the human beings and the natural psychology that plays into it. We are very much at a similar duration to previous cycles. So I just find it quite interesting, kind of the duration element, but I think the most important thing here is to just take away that concept that psychology drives these durations in many instances. There's obviously capital flows, but that investor psychology is a really important part of it. Now, in this chart here, we've got a quarterly in orange, we've got monthly in blue, and weekly price performance in red. So this is like a rolling price performance. And what we've got down the bottom here in this pink curve is actually taking a sum of the number of days over the last quarter where all three of these were above 20%. So we're talking about a 20% gain on a weekly, monthly, and quarterly time frame. What we can see is that generally this describes serious uplegs. We saw it in 2019, we can see it here in 2021. Generally speaking, we just don't see several consistent days of all three of these being above 20%. It's a very infrequent thing, and it normally describes that, euphoric phase, let's call it. Now, where we're at the moment, we've got a couple of days starting to tick higher. In fact, there's been 5 days actually. 5 days where we've seen all three of these metrics be above 20%. So again, it's telling us that as we approach the previous all-time high, which you can see here in 2020, is about the same time that this metric started ticking higher as well. We are attacking the all-time high, and we've had 6 consecutive days where on a weekly, monthly, and quarterly basis, we're up over 20%. So it's starting to speak to this, transition phase between what I've been calling the enthusiastic bull. We're knocking on the door of the euphoric bull, because breaking that previous all-time high, as many investors know in every asset, breaking the all-time high is generally speaking something that gets people's attention. It'll show up on the news, it'll show up on all the different channels that generally expand the pool of people who go, oh, I heard about that Bitcoin thing, now it makes sense, and with these ETFs there's all these extra dynamics. So the next section, what I want to do, we're going to basically do 2 more sections. The first one's going to be on exchanges and ETFs, and just getting a bit of a feel for the supply and demand balance, understanding where coins are going, where they're coming from, what the scale and the magnitude of things is. And then we'll move across to the long-term holders, and they really fill that third part of the puzzle of who is actually selling, and we'll find out more about them shortly. So in this chart, we've got three traces. In the orange in the background, which for the most part we can probably ignore, it's more just for a bit of a sense of scale. It's the USD value of the coins issued to miners. Now, for most purposes, we can generally assume that this is just sell-side pressure. For the most part, miners, because of the amount of literal work they have to do and the cost that they have to cover, generally speaking, at least from my perspective, I usually, if I'm doing one of these supply and demand balances, I just assume it to be sell-side. For the most part, miners sell the vast majority of the coins that they mine. Now, in the blue, we have the net flow coming in and out of exchanges. Now, what I want to highlight here, we were in a kind of typical oscillation rhythm all through 2023, but then look at October. We mentioned October before, and you'll hear me talk about this all the time because it really was a phase shift. Note how the amplitude of inflows to outflows to inflows to outflows to inflows, this thing here, the amplitude really picked up. The volatility really kicked in as the market really started to price in, speculate on, try and work out as to sell the news event, so on and so forth. Then the ETFs went live in January, and the outflows have just taken over. Now, this green curve here is then the ETF inflows. Again, all of these are in USD. Naturally, some of the coins coming out of exchanges, particularly coming out of Coinbase, for example, will be going into the ETFs. There's a reason why these are kind of equal and opposite. But you can see that there has been a significant phase shift where coins are now flowing into the ETFs. This is on a 7-day moving average basis, by the way. And I mentioned it earlier, $300 million is our kind of typical inflow at this point in time on net. Really just incredible numbers. I think it's blown away most analysts in terms of just the sheer scale that we're seeing hundreds of millions of dollars flowing into these ETFs each day, with a very significant chunk, almost equal and opposite, actually slightly less than, flowing out of exchanges. So there's kind of this supply and demand balance playing out over time. Now, sticking with the exchange framework and also just looking for when phase shifts. What we've got here is the average size. So how big is the average coin flowing in or out of exchanges? Now we've got three traces. We've got in blue is Coinbase, in orange is just the average across all markets, and down here in yellow is Binance, which is the largest exchange, largest offshore exchange. On the left, we've got inflows. On the right, we've got outflows. You can see they're actually telling a very similar story. So the interpretation here will apply to both. But for a very long time, multiple years, the typical size flowing in and out of any of these exchanges was between about 1 Bitcoin and about 0.4 BTC. That was a very typical range flowing in or out on an average size. These ETFs have absolutely changed the game. For Coinbase, for example, we are seeing typical inflows of 3.8 BTC. We are seeing typical outflows on the order of 3.8 BTC. And this is the average size of the transactions. So obviously, there's going to be transactions much bigger than that, also some smaller there, but we're seeing that the average has reached an inflection point. And across all three of these exchanges, we've seen an uptick. Binance, we're seeing a lot more on the outflow side, not really a great change on the inflow side, which is quite an interesting observation. So Coinbase is clearly leading in terms of the institutional scale of this, but Binance is also one of the largest exchanges by balance. So there will be these arbitrage where coins have to move between exchanges in order to fill order books in different ways. Different market makers will have supply and trading on different venues. These coins will naturally move and migrate and transfer around the system. In many ways, this is kind of the system that gold could never quite replicate, is this layer of settlement where you've actually got coins that need to settle arbitrage, but because Bitcoin only has a 10-minute transaction time rather than, a plane or an armored ship trying to move gold around, we're talking about a whole different ballgame in terms of how quick that value can actually move around. So market makers will be sourcing liquidity from many different exchanges. And of course, at Glassnode, we have a very, very broad suite of exchange metrics, including probably an important metric, which is exchange to exchange flows. So we can actually start to model out where Coinbase coins are going, where Binance is going, and looking at these flows between them. A lot of that will be arbitraging down these various premiums. Okay, so for the final section, I want to focus in on the long-term holder cohort. And I think it's a good place to set up with their cost basis. We've got cost basis for three different, this is actually one of our most popular metrics, looking at the cost basis by cohort. We've got the realized price, which is the cost basis of every Bitcoin. We've got the cost basis in blue of all the long-term holders. These are coins held for more than 5 months, 155 days. Why do we pick this threshold? Statistically speaking, when a coin has been dormant in an investor's wallet for at least 155 days, and this is a study that's been replicated elsewhere, plus or minus 10 days here or there, what we see is that they're much more likely to stay dormant. So that's why we call them the long-term holders. They typically represent coins that are not mobile. And then finally in the red, we have our short-term holder cost basis. Now this one here is a lot more mobile because it's representing that hot ball of money that's following the price. We'll look at this in just a second. It will tend to act as resistance during bears and support as it has 1, 2, 3, and now 4 times during uptrends. So we do tend to see that the short-term holder cost basis is for more active managers going to be a more useful tool, whereas some of these longer-term investors, it's going to tell you a story about what's going on at the extremes. Now, to take away, the average long-term holder realized price, or their cost basis, is $20,600. So that's really telling you where the average coin that's been held for a long time was acquired, $20,600. Now, actually, I'm just going to jump down to this chart before I go to MVRV. I think this will be a bit easier to understand. Let's follow on from that logic. So this red area of the price chart is all of the coins that would be in that short-term holder, 155 days, and everything behind it is represented by the long-term holders. So what I want to note here, note that long-term supply, as we approach the all-time high in 2020, long-term supply stopped this long-term uptrend and started to decay, and note how it decays much faster into the market high. This is long-term holder selling pressure. These are people taking chips off the table. Coins that have been dormant for a long time, were acquired in the previous bear, are now being distributed and sold to new short-term holders who are hearing about Bitcoin for the first time on the news. So this is this kind of natural market dynamic that plays out not only in Bitcoin, we just happen to be able to see it in Bitcoin. This is taking place in every asset. If we had block time for gold and we had block time for NASDAQ and we had block time for any asset, you would be able to see all of these transactions and the movement of coins between long and short-term holders. They'd probably have a different threshold, but for the most part, this is just describing what happens in markets. We just happen to be able to visualize it. Now, what we can see is that since 2021, long-term supply has been in a long-term uptrend. In fact, it hit a very strong all-time high, about 15 million coins back in November last year, but it has since, as we attack the all-time high, started to decline. Now, it's important to note that some of this decline, and actually we have a chart in a second that will show you that 57% of that long-term holder supply decline is actually GBTC, because those coins were accumulated back here in the 2021 bull. So they have reached long-term holder status, and there's been over 200,000 BTC that's flowed out of there thus far. So that represents 57%. What we're going to look at over the next section is what is not included in that 57%. We're going to be talking about the remaining 43% of the coin supply. So just moving back to MVRV, because what we're looking at here is long-term holder MVRV, and we've plotted down the bottom here. This is actually from our risk analysis framework. We put out a report on this last week, so I'd actually strongly recommend, if you want to check that out, jumping onto our Glassnode Insights portal, where you'll find this on the risk framework, where we actually developed this tool. So I'll let you go through the thresholds in that report. What we're looking at with MVRV is across, depending on what cohort you're looking at, it is the unrealized profit or loss multiple. So the way to think about this is obviously high values means that they're holding very large paper gains. Low values, particularly below 1, means that they're holding an unrealized loss on average. This is actually related to the cost basis above, and we actually use this to calculate our cost basis, or vice versa. Now, what we can see is that we are currently attacking a level of MVRV of 3.5 for long-term holders, which is pretty much the exact level that we hit as we hit the previous all-time high in December 2020. Now, at this point in time, the way to think about MVRV is that the average long-term holder, if it's at 3.5, that means they're up 250% on average, because 1 is their break even. So you've got 2.5 above that. 250% is the average unrealized profit by long-term holders. That level is typically sufficient to start bringing supply back onto the market. Most long-term holders do absolutely nothing until they get at least 250% profit on average, and then they start to spend. At the exact same level that we hit in 2020, then they start to spend. And that's actually where these thresholds come from. Historically speaking, an MVRV of 3.5 is pretty much where people start to do something. They start to take action. They start to take chips off the table. Now, MVRV can go much higher. We get up to over 10. So this is 1,000% on average, by the way. Unrealized profit and loss for long-term holders in 2021. And we have hit much higher multiples in earlier years. But it's just interesting that as we attack the all-time high, we're pretty much at the same incentive level. Let's call it that, an incentive level for long-term holders. And as a result, this chart here is looking at, again, long-term holder supply. We can see that their supply is starting to decline. This chart down the bottom here in the blue is what we call our binary spending indicator. So there's a few words there. We are looking at how many days in a row does long-term holder supply go down. Because it will only go down when the spending by the long-term holder cohort exceeds the amount of coins that are crossing and maturing into their bracket. So generally speaking, we see large upticks in their spending over a 14-day period. So we're seeing 14 days of consistent spending behavior where every single day their supply is going down, typically aligns with these euphoric phases of bull markets. And we have, as of this week, actually hit that level where we're starting to see over, I think it's 8 days, if I'm not memory serves me correctly, 8 out of the last 15 days. So we're over 50%. And once we get up to 15 consecutive days, it typically aligns with these very, very hot peaks. We saw it back here in January, where long-term holders are releasing a significant amount of coins back into circulation. And that's the thing to be aware of. When these long-term holders are spending, a lot of these coins the market has discounted as dormant. They've been taken off the market for 6 months, a year, 2 years, 5 years. Sometimes, in fact, back here in 2021, we saw some very, very old miners actually bring their coins back online and sell into the rallies. We came up to 20,000, 40,000, 50,000. That was actually where the majority of spending came from. So higher prices do create the incentive for coins to come and fill that gap, right? Price is the meeting between supply and demand. When demand pushes prices higher, there is an incentive for those existing longer-term holders to bring that supply back to market. Now, in terms of a sense of scale, what we've got plotted out here in both green and red, which is the same chart, just neatly plotted out just to make it a bit more visually appealing, this is the long-term holder net position change. So what we're looking at is over a 30-day period, how much has long-term holder supply changed, increasing or decreasing? And this here is that massive amount of spending. This is essentially the rate of change of that spending curve. And what we're looking at here is this is when all those old miners were bringing their coins back online in and around the January peak at about $42,000. Now you can see we have a non-trivial 230-odd thousand Bitcoin coming out of long-term supply every single day. Sorry, over a 30-day period. This is a monthly basis, mind you. And this little purple curve here, which you can almost barely see, that's GBTC. So let's actually just get rid of our previous bull market, because I think that's probably clouding things a little bit. These are the GBTC coins that are being spent and moving either to another ETF or just being divested. And you can see it represents a pretty significant chunk of our red. It's actually 57%. So of the long-term holder supply decrease, about 57% of that is responsible directly for GBTC. So that means we're talking about the remaining coins are actually investors taking coins off the table. So in theory, we could in fact correct our long-term holder supply if we really wanted to. But again, GBTC is still net sell side, especially when you've got the likes of Genesis and various other entities, FTX estate, who have to actually just net sell. So rather than actually correcting this, it's just more about the nuance so analysts can go into various levels of detail. Now, the last thing I want to touch on is looking at the breakdown of long-term holder coins. How in profit or in loss are they? So what this model is set up to do, it's looking, you can see this is on a percent basis of all of the long-term holder coins. what percentage of those that are being spent, so of their total balance, how much of their balance are they spending in profit or in loss, green or red. And we can see we've seen a major uptick of coins in profit. In fact, 0.15% of the long-term holder balance, which is a large number, by the way, because long-term holder balance is up over 14 million coins. So 0.15% is being spent in profit at the moment. So we are seeing an acceleration. This is, again, very typical of what we see during uptrends. We see an acceleration as prices go higher. It brings more and more and more supply back online. Long-term holder supply depletes, which obviously moves those coins not only to holders who probably only heard about Bitcoin yesterday or they've bought their first coins. So it moves it to less experienced investors, but the sell side pressure ramps up. And not only that, there's now more coins that are bouncing around in liquid circulation. They haven't been taken off the market and put into a hodler's wallet. So, the question is, what are the type of signs that we will see when the market's getting a bit overheated? And really, this is trying to provide a bit of a framework. We see long-term supply depleting. We will see things like coin days starting to increase, coin days destroyed. We'll see realized profits start to tick higher. We'll see MVRVs hit unrealistic levels. We'll see SOPA, which is the spent version of MVRV, hit very high levels. These are all the type of signs that they accelerate into the peaks because we're essentially seeing investors divesting and we're seeing new, less experienced investors taking ownership of those coins, and they tend to have a higher cost basis. They tend to be a bit more price sensitive, and ultimately, at some point in time, that is what actually sets the top of these markets. Now, again, we will see whether these ETFs fully change those dynamics, but thus far, the long-term holders appear to be behaving as they have in every previous cycle, which, again, I find fascinating. But Bitcoin just happens to have this very organic structure, and the investor psychology is being baked into this data every single day. So thanks for tuning in for that session, folks. Hopefully you found that useful. A bit of a breakdown between exchanges and ETFs. They really have changed the game in a big way. The flows coming into these ETFs is quite extraordinary. I think it's blown away even the analysts with the most optimistic perspective. So it really is quite something to behold. We are hitting several metrics that look, very much the same as they did in December 2020. Certainly in terms of the incentive to sell. And long-term holders are now ramping up their spending pressure. This is now becoming a factor. So we do see that classic behavior of long-term holders being active at the bottom, active at the top, and active as we break the previous all-time high. We see these phase shifts in their behavior, and that is certainly playing out thus far. So I hope you found that useful, and I will catch you in the next one. Cheers.